President of the London College of Energy Economics. Good to see you, Yusuf. Now, we've seen prices rebound very quickly after that sell-off on Monday. Does this tell us that oil is being driven more by perception than actual supply risks?
Saeeba, good morning, and always happy to chat to you. Well, I believe the volatility has been quite high since the outbreak of the conflict. The uncertainty is also quite high because literally traders have no clear direction how this conflict will end, and because the longevity, the longer this conflict remains, the riskier the global energy markets there will be, because we will have very limited supplies, and that will drain the stocks that we are currently in fact relying on. So I wouldn't be surprised that we're seeing this huge volatility that we haven't seen since the COVID pandemic in 2020. And I believe as the longer we see this fluctuation in terms of because one day we see Trump making a post about that there was the negotiation about the ceasefire, and the next day we see that the Iranians quite remaining stubborn and the conflict is continuing. So I believe this is all making a significant burden on the continued closure of the strait, which is actually the most significant development coming out from this conflict. It's not just oil, also the impact that we're having on global trade as a whole. All commodities also increase the burden, and that ultimately will affect global oil demand. So I would expect the volatility to remain until we see a certainty coming out, either on an expected how this conflict is going to end, or a potential ceasefire perhaps coming in the days or weeks ahead.
Right, so do you think markets are underestimating the risk of a broader regional escalation, or has oil already priced in a worst-case scenario?
Well, I think the market has no clear certainty on how this is going to develop. We cannot say that the worst-case scenario is behind us yet. That's because the market so far is expected that this conflict is going to be short-lived, perhaps weeks, but not several months. And looking at the decision that we have seen so far, we have seen a major release of oil stocks from the IEA that is going to stay for something like three months or more. Also, really, perhaps Chinese stocks are almost somehow at a very high level for 4 months. But really, the longer this remains and we see a continued usage of these stocks going down, bringing them down to 50% or low, I think then you're going to see a major impact on oil prices. Because so far Brent and WTI are trading around $100, $110, but we haven't seen 120, unlike Oman and Dubai, which have skyrocketed more than $150, because these are the actual crudes that come out from the area. So I think if this conflict continues for months to come, then I would expect Brent and WTI to escalate above $110.
And with more than 40 energy sites reportedly damaged across the region, how significant is the supply disruption at this stage?
Well, the issue here, Saeeba, is even if this conflict ends and we have a complete reopening of the strait, the damage that has been made to energy sites in the area, whether it's in Qatar or due to a closure of major fields, Kuwait and some other, or Iraq and some other countries, that will require repair. For example, Qatar just announced that 17% of their LNG capacity is now lost, and that's going to take 5 years in fact, to restore them back. So the maintenance will take 5 years. That will have, again, a ripple effect on oil, because that means LNG prices will be high for the next 5 years due to shortages of supplies. So I think there needs to be at least 6 months for the area to bring back its oil supplies to their levels for the crisis. And for LNG, I think it's going to take a few years to bring back the capacity that we have seen before that. So certainly the impact here that we're going to see will be quite significant for the years to come.
Yousuf Ash-Shamari, President of the London College of Energy Economics, thank you very much for your insights.
My pleasure.